Welcome to Wealthcraft. Today, we're diving into one of the easiest and smartest ways to start investing: index funds. If you're new to investing and want something simple, low cost, and proven over time, index funds might be the perfect fit. In this video, we'll break down what index funds are, how they work, why they're ideal for beginners, and how to start investing step by step. For example, the S&P 500 is an index that includes 500 of the biggest companies in the US. An index fund that tracks the S&P 500 invests in all those 500 companies. So, when you buy one share of that fund, you're indirectly investing in Apple, Microsoft, Amazon, and many more without needing to buy each one separately. Let's get started. First off, what is an index fund? An index fund is a type of investment that automatically follows a group of stocks, known as an index. Why are index funds so popular? There are three big reasons. Diversification. Instead of betting on one company, you're spreading your money across many. This reduces risk, WPs. Because index funds are automated, they cost much less than actively managed funds. Consistent returns. Historically, index funds have performed better than most actively managed funds over the long term. You're not trying to beat the market share, simply matching it. Now, let's go over the types of index funds. Stock index funds follow stock indexes like the S&P 500, NASDAQ-100, or Dow Jones. Bond index funds track bond markets and are safer, offering steady income. International index funds include companies from outside your home country for more global exposure. You can choose one or combine different types for better balance. How do index funds actually work? Let's say you invest in an S&P 500 index fund. Your money is pooled with others and used to buy shares of all 500 companies in the same proportion as the index. When these companies grow and pay dividends, your investment grows too. You don't need to do anything, no picking stocks, no guessing trends. It's automatic and passive. Now let's talk about returns. Over the long run, the S&P 500 has averaged around 7 to 10% annual returns after inflation. That may not sound huge, but thanks to compound interest, your money grows faster over time. Example, if you invest $1,000 every year for 30 years at an 8% return, you'll have over $113,000, even though you only invested $30,000. That's the power of long-term investing. So how do you get started with index funds? Step 1. Open a brokerage account. Choose a trusted platform like Vanguard, Fidelity, Charles Schwab, or an app like Robinhood or M1 Finance, depending on your country. These accounts let you buy and hold index funds easily. That means you don't sell when prices drop because they always rise again over time. Let your investments grow with patience. You don't need to check your account every day. Step 2. Choose your fund. Popular choices include Vanguard S&P 500 Fidelity Zero Total Market Index Schwab. It's a U.S. broad market ETF. Read the fund details. Look at the fees and what the fund tracks. Step 3. Start investing. Decide how much you want to invest. Step 4. Hold and grow. Index fund investing is not about timing the market. It's about staying in the market. A good index fund has an expense ratio under 0.20%. How much should you invest? You don't need to be an expert or spend hours watching markets. Just start, stay consistent, and let your money grow. That depends on your income and goals. A common rule is the pay yourself first method. Set aside 10 to 20% of your monthly income for investing. If that's too much now, start with whatever you can: $10, $50, or $100, and grow it over time. Let's also talk about tax benefits. If you invest through retirement accounts like a 401, Roth IRA, or similar options in your country, your money grows tax-free or tax-deferred. This helps you keep more of your profits and grow your wealth faster. Are index funds safe? All investments carry some risk, but index funds are considered one of the safest long-term options. They don't guarantee profits in the short run, and their value can go up and down, but they tend to recover and grow steadily over time. That's why they're perfect for long-term goals like retirement, a house, or a child's education. What mistakes should beginners avoid? Trying to time the market. It's almost impossible to predict highs and lows. Checking too often. Short-term changes can be stressful. Stay focused on your long-term goal. Vesting money you need soon. Only invest money you need for at least 3 to 5 years. Putting all your money into one fund. Even index funds need balance. You can diversify by adding bonds or international funds. Ignoring fees. Even small fees add up. Always check the expense ratio. To wrap it up, index funds are one of the best tools for beginners to build long-term wealth. They're simple, low cost, and effective. Thanks for watching. If this helped you understand index funds better, don't forget to like and subscribe for more smart financial tips. See you in the next video.